Hi everyone, welcome to today's webinar. So this is the second of our two Academy Accounts workshops. I'm Catherine Patel, I'm a partner with Buzzacott's charity and not-for-profit team. I'm presenting today with two of my colleagues, Jamal Mia and Sachi Blakemore. Just firstly, in terms of some housekeeping, so automatically your videos are off and your microphones are automatically muted. We should have some time for questions at the end. If you want to ask questions during the webinar, then if you just use the Q&A function, which is the speech bubble on the right hand side of your screen within Teams, questions do remain anonymous if you're asking questions that way. After the seminar, we'll circulate the slides and the recording, and we'll also respond to any questions that we don't get a chance to cover today. So the aim is that this is an hour session. We aim to close by 3:30. So if we just go into the agenda for the day. So really the aim of this webinar is ultimately for those of you who are newer to the academy sector or want a refresher on preparing for the year-end statutory accounts and also for the year-end audit as well. As we'd reflected in the first part of the webinar, that last week, the reporting requirements for the accounts are pretty stable this year on year. I'm going to run through some of the areas to focus upon while you're preparing for that a statutory account set, and then Jamal will look at how our Excel accounts template workbook is structured and how that links into the statutory accounts presentation. Sachi will then look at the preparation for the audit visit, which will follow, we see, once those accounts have been prepared. As I said, we've got a little bit of time, hopefully for Q&A, but with the aim of closing by 3:30. So any questions we don't get a chance to cover, we will follow up afterwards in writing. So if we go into the first section, as I said, I'm going to look at the accounts preparation. So really, what does the overall process for preparing those year-end statutory accounts to the 31st of August look like, and what are the what's some of the detail that you need to factor in to that process and the considerations and information that you will need to collate. So if we go on to the first slide, and you may think some of this is quite obvious, but it's really starting with some of the fundamentals in terms of that exercise and the key steps that are required. So it goes without saying that all of the transactions for the year should be recorded within your accounting system. So that's operationally, so your operational income, expenditure, capturing any necessary information from the post-year end period as well, so particularly where you're looking at accruals, invoices that are coming through post-year end in order to give clarity to that year-end position. But there will also be within your system some year-end adjustments that might not be entered into the ledger on a monthly basis for the purposes of management accounts and management reporting purposes. So we'll cover some of those, quite a number of those today as well. In terms of the TB that comes then from the system, making sure that that's fully reconciled and that you understand the balances that sit within there and the transactions as well. So particularly ensuring that those year-end reconciliations of control accounts, the bank rec, have all been undertaken and fully reconciled and agreed with any differences investigated. So covering bank, payroll, VAT, purchase ledger, for example, as part of that. The next main step is then mapping the TB actually to the statutory accounts format. Our Excel workbook helps with that exercise. Key here is consistency in the mapping with the prior year, understanding where all of your TB codes are being reported through. Obviously, unless there are some changes stemming from the ESFA's accounts direction and you do need to change the mapping, you would expect that to be consistent year on year, particularly the categorisation for your income and expenditure reporting. It's worth at this point also doing a sense check to the management accounts. So that overall movement in funds being reported within the statutory accounts, does that make sense and tie into the operational position that your management accounts were reporting at year end? Undertaking that reconciliation exercise really helps to understand potentially some late adjustments relating to the operations, so accruals, but also some of the other year end adjustments, for example, in respect of pension accounting, maybe some of the capital side of things as well. There will then be additional schedules and requirements that are required both for the audit visit, but also for the accounts disclosures. So Sarchi will cover some of those, but being aware really of the disclosures that are required within the accounts and the information pack that you're providing and pulling together at year end, making sure all of those requirements are covered. And I'll go into these in a little bit more detail. But also, for example, if you have accruals, prepayments, that there's a clear listing of what those are at year end, and particularly the more material items. There are also the narrative reports, as we covered last week, in terms of the accounts, so predominantly the trustees' reports, the governance statement. So pulling together all of the information, the governance statement, obviously requiring meeting attendance within there. So you may need to get others involved in gathering some of this information, the clerk, director of governance, for example. And then just a note on the ethical standards. So as auditors, we're able to provide some support in respect to the accounts preparation exercise, but we've got to be mindful of the ethical standards and the necessary safeguards that we put in place. So really just emphasising here that the ownership for that accounts prep is with the trust, ultimately with the trustees, and the responsibility for those accounts, although we'll aid you along the way on this, actually rests with the trust, and we'll need to see evidence of that through the process as well, the sort of review process. So if we just move on to the next slide with a little bit more detail around the sort of the year end and certain areas that you need to consider. So in terms of the overall core financial reporting, so as I mentioned, making sure that those control accounts, reconciliations are all reviewed and the reconciliations are undertaken at year end. Hopefully that's been ongoing on a monthly basis through the year. So really at year end, almost this is just another equivalent to another month end. So the bank, VAT, debtors, creditors, payroll, PAYE, and any other control accounts that you have sitting within the balance sheet as well. Making sure you've got a full review and listing of accruals and prepayments, so that that's available for us as auditors, and also any provisions as well. So again, these may be just adjustments that are made at year end, so potentially holiday pay, accruals, also HR related, being the Harper Trust provision that came in a year or so ago, and then potentially any legal provisions, existing provisions that you have there. Maybe there's a dispute ongoing, really re-looking at the value of that, or introducing a new provision into the balance sheet at year end. Looking at the various sort of elements of income that you receive, for some, quite a number of trusts and schools, you have school funds, governor funds, considering the income and the expenditure relating to these. Sometimes for newer multi-academy trusts or newer trusts, the governor's funds have been kept separately outside the accounting system. So making sure you're capturing absolutely everything that's under the control of the multi-academy trust, of the single academy trust. And looking at how they're accounted for. Typically, they'd be coming in as unrestricted income, but potentially some elements of donations may be captured as restricted. You'll have trip income, grant income, and we'll come on to a little bit more on grants and funds, but really being clear around the purposes for which you're receiving income in the year, and also the allocation of costs to each of those pots of money as well. Fixed assets, so the capital fund being a ring-fenced fund within a set of Academy Trust accounts, so quite a considerable amount of work to do there in terms of reviewing the capital spend in the year, and also looking at how capital purchases have been funded. So is that from capital grants, or is it from your own reserves, and looking at how that's reflected within the accounts, looking also at the fixed asset register to substantiate the values there on fixed assets. Again, I'll touch on this a little bit more. And then you've got the local government pension scheme valuation, which is the actuary's valuation of your share, or the individual school share of the relevant local government pension schemes. Typically in the past, that's been a liability that appears on the balance sheet, and the annual movement is reflected within the accounts. Potentially this time round, we're likely to see more surpluses and assets. So again, something else to consider there. The key in the preparation is liaising with the pension scheme, the actuaries, to ensure that that report or reports for all those schemes are delivered in time. Further year-end information, absolutely critically here, is the fund analysis, and I'll cover that in a little bit more detail. But really, how is each funding stream being spent? Are the costs being matched to those funding streams eligible? And what are the unspent balances of funding streams at the year end? Also, from a fund perspective, considering schools coming into the trust and schools departing from the trust. So how does that impact on new funds coming in and equally funds being transferred out of the trust? And then there are numerous, as you'll be aware, further disclosures required within the statutory accounts, required predominantly by the ESFA, but also because you're a charity as well, so follow the charity statements of recommended practice. So really crucial that you understand what all of those additional disclosures are, and that you can prepare information relating to all of them for inclusion within the accounts. Final consideration is the Academy's accounts return submitted in January of the following year. Again, some further disclosures likely there, and good to be prepared for those in preparing your year-end pack of schedules and information. So just turning to the next slide and coming on to some possible year-end issues as we see for many of our clients, and really the key here is tackling these as early as possible, having a conversation with your audit team if there are any concerns in these areas, really so that by the time of the pulling together the statutory accounts and subsequently the audit, you have a really clear, reconciled and correct set of financial statements. So fixed asset register, making sure that your fixed assets within the accounts, the balance in the accounts, tallies to your fixed asset register, reconciling the two, understanding any differences, checking the opening position on that. Actually, we often see that sort of opening discrepancies from a prior year then are not corrected, and gaps between fixed asset registers and the balance sheet sort of ever increase. Transfers in from new schools, reflecting the assets there, obviously additions, disposals, depreciation charges, ensuring all of those are captured in both the ledger but also in the fixed asset register as well. And actually fundamentally really looking at what is capital that you've spent in the year, and I know a number of trusts do that through the financial year, but others will look at that as a sort of a summer year-end exercise. So being really clear on what's being capitalised and how capital funding has been used as well during the year, and any unspent balances of capital funding at year-end. Fund accounting, I'll come on to a couple of schedules on that. Really absolutely key that the clarity around the funding coming in, the key funding streams and the amount that's been spent in year and matched to those funding streams, absolutely key that is considered at an early point in the accounts preparation exercise. As I said, pension journals, be clear on the journal required. Again, worth liaising with your auditors on that. As I said, quite likely this year that many of the valuations will have tipped into a surplus position, an net asset position. So the degree to which that asset is recognised on your balance sheet needs to be considered. The likelihood is for most that will be capped at a nil balance, so you wouldn't be recognising the asset because it's not deemed to be recoverable, but there is some scope for recognising an element of that surplus. So again, something really there to discuss once you get the actuary's valuation statements through. Opening balances is last on the schedule. Probably the very first thing you need to do is to check that your opening balances in your ledger definitely tally to last year's final signed accounts. If there are differences there will be differences at this year end, and the accounts won't balance. So absolutely make sure that step is checked off. So just moving on to the next slide, in terms of fund accounting. So I mentioned this is absolutely crucial to the core of the financial statement. So this is a replication of the fund note that comes from the accounts direction itself. So this is a more detailed breakdown of income, and expenditure and the balances against each funding stream. It's a more detailed breakdown than anywhere else within the accounts, but you must ensure that the subtotals within this note tally to the other statements. So, for example, against restricted general funds, you have income there of 4.882 million. That must tally to the total income on your restricted general funds within the statement of financial activities. Similarly, that the balance or the expenditure tallies, the gains, losses and transfers figure tallies, and also the balance at the year end as well. So making sure that all of the key figures, the subtotals in this note, tie into both your statement of financial activities, but also your balance sheet. In terms of the pension reserve, so you can see here that's negative 1.413 million. That should be the same balance as the liability for the pension on the balance sheet as well. So really the key here is looking at the individual income streams. You have your brought forward unspent balances from last year as the opening balances. You have your income that's come in against each of the defined funding streams. And then you look at the allocation of expenditure to each of those. And a lot of these will be pretty straightforward. Pensions will be linked to the pension, the actuaries report, fixed asset fund, predominantly depreciation charges, but you will then have your operational spend to look at, and in terms of allocating that against, for example, within the restricted general funds, how much goes against pupil premium, how much goes against the GAG, for example. So really starting with those funding streams that have the most narrow restrictions on them, allocating the cost to those, and then working to the broader, really the broader funding streams, as the general annual grant can obviously fund a number of educational purposes and the broader educational spend of the Academy Trust. But really that note, really worth thinking about, because it does sort of sit at the core of the accounts, even though the note is actually towards the end of the accounts. And then just moving on to the next slide, this is just really a reminder for multi-academy trusts. So the requirement to split those funds subsequently by school. So what you have is your total funds, the 9.4 million here. You don't have to split the pension reserve by school, so that's the total pension reserve, the 1.4 million. You have your total fixed asset fund, and then your operational funds, which is the 742, you have to split between the individual schools and central office where relevant. So ensuring that 742 does tally to your unrestricted funds plus your restricted general funds, and then broken down by school as presented here. Just moving to the next slide, I won't go through this in lots of detail, but this is really a reminder on the numerous financial statements disclosure requirements that are additional to the sort of the core statement of financial activities and the balance sheet. The ESFA and various reporting regulations require you to disclose many further specific transactions and commitments, liabilities. So particularly the first bullet point there, ESFA requirements around specific items of spend in the year that you're required to disclose, losses, severance payments, debt write-offs, land and building disposals, for example. So be really clear on the requirements there. Have a summary of those individual amounts that have the trust has transacted in the year. Funds we've covered, but note the narrative requirements too. If you've got schools that have a deficit level of operational reserves, for example, you have to disclose why that is and what you're doing to address that. Worth just noting on expenditure allocations. So within the statement of financial activities under expenditure, it's likely that for most trusts you'll just have one core heading, which is educational operations. You may have more than one heading. You may have a teaching school hub, you may have boarding, you may have the costs of raising funds. If you do have those three latter items or any of them, you then have to look at how support costs, so the core overheads, are allocated to each of those expenditure headings. Likely that they'll be relatively minimal in terms of the raising funds, teaching, school and boarding, and the bulk of support costs will be going to educational operations, but nevertheless it is a requirement. Just a note here, a reminder that the ESFA this year has confirmed that teaching assistants are considered as support staff, not as teaching staff. So just remember that for this note. Other commitments, capital commitments, anything you've committed to that's not included in your capital spend but have signed contracts, for example, at year end to be reflected. Related party transactions, so making sure you've the declarations of interest and know any transactions that need to be disclosed there. Operating leases, similarly, anything there, rental, photocopiers, etc. Audit fees, disclosures on those, and gains, losses on disposal of fixed assets. Some requirement there around deferred income, so a narrative on the reasons why you're carrying forward some income within creditors. And then the pension disclosures tend to be sort of 5-6 pages long, both covering the teacher's pension scheme, which is a sort of standard disclosure, and then the LGPS, which comes from the actuary's report or reports if you have numerous reports. Agency arrangements, remember those. So this is things such as the 16 to 19 bursary funds, where you're purely acting as an agent, as a trust, to pass on funding to the pupils. The accounts direction covers this specifically, but you have a disclosure note around those transactions within the notes to the accounts. And then just finally on this slide, just in terms of multi-academy trusts, central charging structure, have the information ready and the narrative around the central services and how much each school has been charged in year, and then the balances ready to disclose and include within the financial statements around schools that have left or have joined the trust during the financial year, and again further disclosures around those required by the accounts direction. So just a couple of final slides from me. Just the next one, staffing and trustee disclosures. These are really quite lengthy, many driven by the ESFA requirements, so really worth looking at these in advance of your preparation exercise, because you're likely to require input from other teams, the HR personnel, individuals particularly. Just a couple of notes here. Staff numbers for the accounts, headcount is fine, FTEs optional, but do check the AAR requirements, the accounts return requirements, because FTE is quite likely to be needed for that. Severance payments, so this changed last year, sort of contractual, statutory severance payments have to be disclosed in bandings. That does also include anything that's non-statutory, and then where there are non-statutory, so special severance payments, then these are disclosed individually by amount. So again, information you'll need there, probably from your HR teams. Higher paid employees, so the bandings there. Just be clear here whether pensions and NI are included or not. For the bandings, employee pension and NI contributions are excluded. For key management personnel, this is total remuneration, so includes employers' pension and includes employers' NI. And then for remuneration of trustees, so this is, for example, if the CEO is a trustee, it's the remuneration, salary, plus the employer's pension contributions. So each one of these disclosures is slightly different in requirements. So really just make sure you're clear on that. And then very finally from me, just on the last slide, so in terms of the AAR information, really what we've listed here is based on prior years, but it really is a guide to some of the types of additional information that the ESFA has requested within that annual return. For 2023, the AAR is to go live on the 12th of September this year, so clarity will be confirmed, will be given then. Submission date this year is the end of January 24, so 30th of January 24, but we'll always encourage trust to prep for this side of Christmas and really as part of the main statutory accounts preparation exercise. It's easier to gather some of the information, particularly if it rests with other teams. But yes, just making sure that you're fully conversant with the requirements for the AAR. So on that note, I will now hand to Jamal, who will look at some of that accounts preparation in practice using the Excel template workbook.
Thanks, Kath. Good afternoon, everyone. So I'm going to spend a bit of time talking through our Excel Academy accounts template. So this is the tool that we offer to our clients to help take your closing trial balance and convert it into a statutory set of financial statements compliant with the ESFA accounts direction requirements. It may be that you'll be asking Buzzacott to assist with the preparation of your statutory accounts, but we hope this part of the session will still be useful for you, as it will hopefully shed a bit more light on the process that we go through in preparing those statutory accounts. So on my first slide, I've set out some of the key benefits of using Buzzacott's template. Actually, there's a multitude of templates that we have available, including ones that can be used by single academy trusts, one that can be used by multi-academy trusts, and also those with subsidiaries which form part of a group. But essentially, there's two key reasons for using these templates. Firstly, the Excel workbook helps provide an audit trail between your trial balance and your final accounts. So for most of our clients, the numbers will ultimately end up on a single Microsoft Word document, which contains both the narrative reports, including the trustees report, as well as the numbers themselves. But actually, if you were to look at that Microsoft Word document in isolation, it can be quite tricky to understand the makeup of those numbers and how they've been derived. As you'll hopefully see as we work our way through this session, this workbook will allow you to trace the majority of those numbers back to the source trial balance. And secondly, it will help provide a compliant set of accounts which meets all of the ESFA disclosure requirements. We update all of our Excel templates every year to take account of the latest accounts direction. So any new disclosure requirements within that will be incorporated. And hopefully using those templates should offer you a good level of confidence that the requisite disclosures have been considered in full. And actually, even if you've decided not to use our template or have your own pro forma for compiling the statutory accounts, you may still find it beneficial to refer to these templates just to see how we've approached the workings behind some of those ESFA disclosures. There's a few other benefits to using these templates as well. There's built-in validation and integrity checks throughout the workbooks, which will help alert you to potential errors in the data entry or where numbers which should match in different parts of the accounts are not quite matching. There may also be a need for late adjustments to the figures after the accounts preparation work or the audit work has begun, and these can be incorporated quite easily using our template and allow you to keep a log of all such adjustments during the process. And finally, it also provides you a simple way of aggregating the individual trial balances for multiple schools within a multi-academy trust. And hopefully we'll be able to showcase some of these benefits in a bit more detail later within this presentation. So just moving on to my next slide, we can begin by seeing what this workbook actually looks like. So on the right-hand side of the slide in front of you, you'll see the Statement of Financial Activities tab or the SOFA tab, which pretty much looks like the SOFA that you'll find within the Coketown model accounts. The key difference being that our template has particular cells shaded in different colours. And those colours are quite important. The same colouring scheme has been used throughout the workbook, and to the left of the slide in front of you, we've provided a key explaining what each of those colours represents. So the green coloured cells are user field cells, which means that the relevant figures will need to be hard typed manually by the user. And what you'll hopefully observe when you use the workbook is that we've tried to minimise the use of green coloured cells as far as possible. The whole purpose of this workbook is to allow you to easily track those numbers back to your original trial balance, so it makes sense to try and limit the number of hard type figures. The green cells are mainly used in areas such as staff costs disclosures, where some of that analysis won't be available through your trial balance, or for example with the comparative information where the audit trail for that already exists in the form of last year's records, so there's no need to sort of remap last year's trial balance again. On the other extreme, the blue coloured cells are those which contain a pre-filled formula, which will try and grab the data from another location within the workbook, ultimately flowing the link all the way back to your trial balance. There's also a middle category, the purple coloured cells. Those require the preparer to give a bit more thought as to the best way of pulling the data into that cell, but ideally linking back by formula wherever possible. And This is typically going to be relevant to decisions around fund accounting. As an example, you may have a nominal account on your trial balance, which is used to record all of your donations income, but some of that income may be restricted and some unrestricted. By default, our template will assume that all of the donations are unrestricted, but if that's not appropriate, you may need to adjust the formula in a neighbouring purple cell to help show the correct analysis. So how is it that the numbers are populated, and where do the figures in the blue cells come from? If we move on to the next slide, we'll see the main tab within the workbook, which will drive where the numbers are spat out to the relevant areas of the accounts, the trial balance tab. So the screenshot on the right of the slide in front of you shows an extract of a trial balance tab that's been partially completed. The green cells are where the raw trial balance is originally entered, i.e. columns C, D, and E. And this can literally be copied and pasted from an Excel export of your trial balance taken from your accounting system. The key role for the preparer is to complete column B, the type column. This is what will determine where the number feeds through to within the rest of the Excel workbook. For the template to work, you can only use a type that is available from a predetermined listing. There's another tab within the workbook called Key for TB codes, which contains a full list of the available types, and an extract of that tab is shown on the bottom left of the slide in front of you. So taking prepayments as an example, you would check the Key for TB codes tab to find the most relevant type for prepayments, which in this instance are the letters PRE or pre. And if you've successfully entered a type which is included in that predetermined list on column A of your trial balance tab, this will automatically update, on column B of the trial balance tab, this will automatically update column A to say yes, confirming that that type is valid. If you've made up your own letters or used an incorrect type, column A will say no to indicate that the type that you've used is not valid. If your accounts are not balancing, then one of the first checks that you should be doing is to filter column A for any no answers to check if there's been a typo in entering any of the data within column B. You may at this stage be thinking, why is column B coloured blue and not green? Well, for those of you who have used our templates in previous years and do not wish to have to go through the effort of reassigning the type for every single nominal account again, there's a facility within this workbook to effectively help automatically populate the type by copying and pasting in last year's map trial balance into the prior year tab or prior year TB tab or the PYTB tab. There's full instructions on everything that I'm going through, including the point on the prior year TB within the guidance tab of the workbook. So I won't be covering that in great detail in this seminar, but continuing with our example of prepayments, if you can take a mental note of the balance of prepayments on this trial balance, which is a £200,000 debit balance, we will now move on to the next slide to see how this gets pulled through into the actual accounts. So on the bottom of this slide, you'll see an extract of the debtor's disclosure note, and you can see that at cell P50, the prepayments and accrued income line has correctly returned the £200,000 balance we saw as the prepayments balance. If you take a look at the Excel formula bar on the same screenshot, you'll see for cell P50, you'll hopefully see how the type mapping is now being used by that formula to return the correct value. This Excel formula is used throughout our template and is simply asking Excel to add up all of the figures on the trial balance with the relevant type, type name used at the end of the formula. For the preparer's convenience, at column T, we've made a note of the relevant type that is being searched for by the formula in that specific row to save you having to look through individual formulas if you're trying a troubleshoot. On the next slide, I mentioned earlier that there may be a need to make further adjustments to the numbers after the accounts work or the audit work has begun. Any such adjustments should be recorded in either the Accounts Journal tab or the Audit Journals tab, depending on whether the adjustment was identified during the accounts preparation phase or during the audit phase. So say, for example, we determined during the preparation phase that an insurance prepayment of £5,000 had been missed. You can see on the top right-hand screenshot the details of the necessary correcting journal that will be needed to make the correction. Now, so long as the nominal code is correctly entered within column B of the Journals tab, the formulas included within the Journals column of the Trial Balance tab, i.e. columns H and I on the bottom right screenshot, this will automatically process the necessary journal and adjust the final values to be used in the accounts. Whilst this process is automated to a large degree, please do be careful, as a typo in the nominal code in the Journals tab could mean that the adjustment is made to the incorrect trial balance line or not adjusted for at all. So on the next slide, we look at the funds disclosure note. As Kath previously highlighted, this is a critical disclosure note within the accounts. Unfortunately, this workbook or any other workbook or software will not be able to miraculously produce a set of financial statements which are 100% finished on an automated basis. And one of the key reasons for this is fund accounting. It's very unlikely that the way your accounting software will export the results for the year to a trial balance will provide full analysis, the full analysis needed to be able to easily map the movements on individual restricted and unrestricted funds during the year. So a more careful review of this disclosure will be needed by the preparer here. Our template is set up to make certain presumptions regarding fund movements, but those presumptions may not be accurate or appropriate for your circumstances. To be fair, the first two columns should be pretty straightforward, though. The balance on the brought forward column is a green coloured cell, which will be hard typed from last year's accounts, and the income should generally be mapped out okay, depending on how detailed your chart of accounts is. It's rarely the expenditure column where a bit more attention is needed. As an example, the template is set up to make the assumption that pupil premium income for the year or the other grant income for the year will have been fully expended in the year of receipt. And this may not be appropriate for your Academy Trust, in which case the formula in column L may need to be amended. Similarly, there are typically various rows included within the restricted fund, fixed asset fund section of this disclosure, and depending on how your fixed assets have been financed. But the trial balance will likely show how the total depreciation charge for the year has been analysed by class of fixed assets rather than the funding source. You will therefore need to determine the best way of allocating the total depreciation charge for the year between rows 31 to 34 within this disclosure note, and that may mean manual input or looking at a formula in those cells. Similarly, on the next slide for multi-academy trusts, there's a need to disclose the revenue reserve balance by individual school. Again, the template will try and calculate this based on the figures in the individual school trial balances for income and expenditure. But again, the way these balances are calculated may not be the most appropriate, and therefore this should be checked against your own expectations and your own management accounts, and if necessary, the formulas adjusted as needed. On my final slide, just a few additional pointers. Firstly, as I say, there is a guidance notes tab included within this workbook. Please do read through this before starting the work, as it will provide you with a very detailed step-by-step guidance on how to use this template. It may be that after you've completed the various steps that you find that your accounts do not balance. If this looks to be just a rounding difference, our recommendation would be just to check the final column of numbers in the trial balance tab. The workbook is designed to round off your trial balance to either the nearest pound or the nearest £1,000. And if your trial balance is not netting down to exactly zero, then this has probably arisen because of this rounding process. If that's the case, just manually adjust one of the largest figures within the final column, adding or minusing 1 or 2 as needed to clear that difference. But it may be that that imbalance is not because of rounding, but because some of those TB codes haven't pulled through to the accounts properly. And there's 3 things that you should do to try and zero in and identify the cause of that imbalance. Firstly, I mentioned earlier about double checking the very first column in the trial balance tab to check whether all of the type codes that you've used were valid. Do check that the type codes were included in that predetermined list, that key for TB codes tab. Just on the right hand side of the trial balance tab as well, you'll see another set of filtered columns that show exactly which disclosure note the figures will have been taken to. You could also use those filters to help isolate and potentially locate the source of the error. And finally, you'll notice throughout the accounts template, there are validation boxes included on the right-hand side against any of the figures. You can see an example of this on the screenshot to the right of the slide in front of you. These boxes are designed to light up and alert you if there is an issue with the data that's pulled through in a particular row. So again, addressing these items first should help you identify the cause of the imbalance more efficiently. Also, please do feel free to make changes to the templates to meet your disclosure needs. As we say, we've modelled this template on the Coketown model accounts, but we know that some academies do like to include additional analysis over and above what's included within Coketown. But where you do this, please do try and use the same sort of formulas and principles as for the rest of the template. The more you start adding in hard type figures, the more difficult it becomes to see that clear audit trail. Finally, there is an accounts return tab also included within the template. For the avoidance of doubt, this template is not going to populate the entire accounts return tab for you, but this tab is designed to capture some of that additional information that may be needed at a later stage for the population of the accounts return. If this is completed at the same time as the accounts, then we will already have a lot of the information that we'll need for that part of the process. And I think that's everything for me on the Excel account. So I'll now hand over to Sachi, who will discuss some of the audit preparation requirements in a bit more detail.
Thanks, Jamal. So I really wanted to cover the sort of practicalities of preparing for the audit. And really, before I do that, just one caveat. For those of you who attended last week's seminar, my colleague, Matt Harry-Chaichuk, he covered ISA 315, which is around looking at IT controls, finance data. It's a new requirement. I'm not going to cover it today. I'm really going to focus on the core of it, core of preparation for the audit, which to summarise, it hasn't fundamentally changed. So the purpose of today's session is just to remind you of the key things to consider when preparing for the audit. Okay, next slide, please. Okay, so what is the ultimate aim of the audit? The ultimate aim is we provide three opinions in respect to the financial statements. The first is in terms of the numbers, the statutory audit. We're really looking to give an opinion on the truth and fairness, i.e. do we agree with the numbers presented, the disclosures, but we're also looking at the compliance requirement that the ESFA has for academies. Are you ensuring that you're incorporating that and we agree with those disclosures? You're also a company, you're compliant with UK accounting principles and so on. The other opinion we give is also part of the financial statements. It's a report that follows the statutory audit and it's in respect to the regularity assurance. The regularity assurance is actually from the ESFA's perspective, and it applies to every academy, it's limited. So whilst we do tests and checks, it's not the same level of assurance that they expect in terms of the statutory audit, and that's not a change from last year or the year before. That's just to emphasise that it is limited in scope. Likewise, once your financial statements are submitted in December, that the final piece of assurance that we do is in relation to the AAR return. We have to audit that. We have to make sure the disclosure is compliant. And similar to the regularity assurance, the opinion we give is limited, and that also is same as the previous year. So next slide, please. In terms of what is it that we are looking to get from the Academy Trust, collate for our audit, well, in essence, we look through each of the key areas, both in your balance sheet and your income and expenditure statement. And just to give you an example, you will see a display of a section of our audit file. And if you follow through each of the sections, they follow the balance sheet, they follow the income and expenditure, and we meticulously go through each area doing testing across the board. And the work we do really is about understanding where your numbers come from. Are they valid? Are they complete? And the sorts of checks we do include things like looking at the sort of the information supporting the figures in the accounts, but also we're really trying to understand variances from the previous year. In some areas there would naturally be variances, but there's other areas there would be a similar trend to previous year, and we will seek to get explanations from you in that regard. The other thing I would mention is that whilst we do testing across the board, there is an emphasis on certain higher risk areas. For those of you who've been through the planning process with us, you will have already received, hopefully, or most of you will have received your planning letter. And you will see within that we identify specific high risk areas and we report against them. And against those higher risk areas, we tend to do a bit more work. So if you take the example of academies, typically given the large size of estates that any academy trust has, there will be some level of work around repairs, capitalisation each year. There might be work that is over the year end. And one of the risks when you've got a large capital project is that the numbers don't fall in the right period, particularly if you're straddling the year end. And we do a bit more stress testing around that, for example. So next slide, please. In terms of the information required for the audit, Kath in her session talked about basically reconciliations, how they're important and how you go about making sure the numbers agree. And I think we will definitely need all of the balance sheet reconciliations, but the most fundamental thing is to get a final trial balance from you. And for all the key items on the balance sheet, the reconciliations that you've prepared, but also it's the breakdown of those items. So if you've got accruals, you've got prepayments, fixed asset additions, all of that, we will need a bit more detail around that so we can do the checking. But outside of the trial balance and within some of your other finance data that you hold systems, there will be information that you'll need to collate. So we will need disclosures around the higher paid staff, how many staff you have, and so on. And all of that is compiled in relation to the numbers, the disclosures, but equally we need to get a view of how the organisation has operated throughout the year, and we'll ask for things like the minutes of the board meeting, the Finance and Audit Committee meeting. We'll ask for declarations of interest from each of the trustees, senior management. We will also want to be doing the forward-looking piece, and I'll talk about the going concern in a minute, but what are your budgets and forecasts for next year, so that we have a sense of the liquidity position, particularly at the point of sign-off. Next slide, please. And each year you will receive from us a prepared by client list, and we call it. It's a list similar to the accounts preparation side. We prepare a list, we issue one for the audit, and we do it section by section. And you can see from this slide, there's an opportunity for you to go through and check off each of those items have been prepared for the audit. Typically there will be some changes, particularly if there are disclosure changes or requirements, but on the whole it will be very similar to the previous year. What I would emphasise, and I think this really will help with the audit preparation, is that if you can have everything on there available, and in the odd instance that you're still working on it, what really does help is if you can indicate a time, so that the audit team, when they look at this as part of the audit, that they can see either it's available or there's a timeline as to when it will be provided. So moving on to the regularity, propriety and compliance assurance that I talked about. The purpose of this is really, there's 2 or 3 elements you can draw out of it. The first is that in relation to regularity, what do we mean? What does the ESFA mean when they want us to give an opinion in regularity? Is that they really, in essence, want us to assure them that the Academy Trust has basically spent the money for the purpose intended. So you receive GAG funds, they're really there for educational purposes of the Academy Trust, and are you spending it for that purpose and not for anything outside of your main purpose of existence? Then there is the piece around propriety, and propriety really is about conduct or behaviour, and it's really you may well be spending the money for education, so therefore you can tick off the regularity piece, but if you're not going about looking at, let's say, when you're procuring things, you're not ensuring that the contract is efficient, it's effective, it's economical. There's a possibly an extravagance in some of the expenditure, that could be considered something that's not proper. And so it's around that cultural piece, the reasonable checks, that we are really looking to see that the Academy Trust is compliant. And then there are a series of sort of musts, and the Academy Trust Financial Handbook basically has, or Academy Trust Handbook as it's now called, has a series of good practice, shoulds, etc. But it also has a series of musts that you need to comply with. And if you're not familiar with this particular handbook and Section 8, or Part 8 as it's called, it includes actually a series of top 10 musts, and I think it's really valuable for the Academy Trust to look through this at certain points in the year to make sure you're complying. So it will include things like you must circulate management accounts to the Chair of Trustees every month, you must publish individuals' pays above 100k on the Trust website, etc. And again, as part of our work, we will be just checking through that you have complied with those musts in relation to the regularity work. So what are some of the issues that sometimes end up having to be reported in the regularity report, and if possibly they're not of a magnitude that deserves mentioning in the regularity report, we certainly need to flag it up in our management letter, where they sort of are basically items that don't comply with the requirements that you'd expect to see. So for example, sometimes we see instances where transactions, related party transactions with trustees or senior personnel at the trust have taken place, but they're actually above cost. You're not, in this instance, the handbook is very clear that they need to be at cost. And so if they exceed that, there's a requirement to report. Another example would be where you've entered into a finance lease. As an Academy Trust, you can't borrow. Finance leases are deemed to be borrowing. And if you haven't sought the SFA's permission in advance, then it could be something that needs reporting. The other sorts of things just to be wary of, or just being mindful to ensure that you are complying, is things where financial procedure manuals haven't been updated, and so on. So it's really about having good, proper controls in place that enables you to comply with the trust handbook. So how is it that we go about auditing, and how do we get you to compile that assurance for us? We have prepared a self-assessment checklist, and we've done so for a number of years. And as part of the planning, once we have the planning meeting, we issue that alongside various other questionnaires. This year, you'll have the ISA 315 questionnaire. We'll send fraud questionnaires, etc. But we also send a self-assessment questionnaire, and that asks a series of questions. And what we do once we receive that from you is we sort of do checks and balances. So if you say you're complying with a particular process, or there's a particular form of reporting or authorization, what we're really looking for is evidence of that, to make sure that if you say that's what you're doing, then we can tick it off. And on the next slide, there's just a sort of an extract of a little bit of the self-assessment questionnaire, and you can see the sort of questions that we're asking. And to help the Academy Trust, in the very last column, we sort of give examples of the sorts of things that you can provide to us as evidence that you're complying with those requirements. There may well be other examples that you can prove, and the objective in advance of the audit is really for this questionnaire to be completed, to be available, and we also request that it's ultimately signed by the accounting officer as well. Next slide, please. So a couple of other things to consider as part of the audit preparation. One of them is going concern. What going concern is really an assessment of the ability of the Academy Trust to pay its liabilities for at least 12 months. 12 months is a relatively short period of time. I appreciate Academy Trust will have a longer frame, they'll budget for a number of years, etc. But for the purpose of the audit, we really are focusing particularly on that 12-month window from the date of sign off. So for most Academy Trusts, if we sign off in December this year, we're looking to to get something from you that relates to the next 12 months to the next following December. Really, it's the trustees' assessment of going concern. You will have to make a statement in the financial statements, both in the trustees' report and the accounting policies in relation to that. And in order to do that, what we need from you, next slide please, is really good practice would be that is to prepare a document for your finance committee, your audit committee, that sets out the basis of why you believe to be a going concern, and we will then audit the assumptions, the information you provide. But typically the three key things we're looking for is your cash flow forecast for the next 12 months up to December. We're looking at the latest management accounts at the point of sign off just to see what the results have been following the year end. And we'll also look at your budgets just to make sure that the assumptions used are reasonable and appropriate. And then the following, the very last slide before I finish is in relation to reserves. So again, this just needs a little bit of planning. This is in relation to your free reserves. So every Academy Trust has to have a reserves policy. And the objective is that in your financial statements and the trustees report, you have this policy, and then you state where you are at the year end. Typically, free reserves are everything that are part of your unrestricted funds. They're really funds that are not, designated for anything specific. They're not restricted funds, but it will include things like your gag funds, which also sit in restricted funds. And is to get them and compare them to your policy. The policy itself will vary from Academy Trust to Academy Trust, the size, the complexity, what stage of development you're at, your future plans. So it's really a risk-based assessment, and there isn't a formulaic, this is what you need to have as reserves. But if it helps, typically we saw a couple of years ago, the ESFA did a bit of research, and they were saying that, in 2021, most Academy Trust on average, and this is an average figure, were holding about 12 to 13% of their operational income as reserves. There was a time when they had suggested Academy Trust think about possibly as an absolute minimum, around sort of 1 month's payroll. They withdrew that for various reasons, but it was just intended as a guide. And I think it's really important that each year that the trustees think about what the reserves policy should be, because it may change from year to year, and you actually report against that. So it's really important that this piece is given attention prior to the audit. That's all I wanted to say, but I'll pass on to questions. Thanks.
Great. Thank you very much, Sachi. We've literally got 3 questions, and I think it's probably worth just answering them because I think they're of relevance in the 2 minutes we have left. So the first question relates to the actuaries report this year for the local government pension scheme valuation. So the question is around the request by actuaries to see whether an additional report this year is required relating to the accounting surplus, so the valuation surplus and the asset ceiling. I mentioned that if you have a surplus on your local government pension scheme in the valuation, that could lead to an asset. The extent to which you recognise an asset is the extent to which that surplus is recoverable, and that is linked to the asset ceiling. So our recommendation would be to receive that additional report from the actuaries around the asset ceiling commentary, because it may then enable you to reflect an asset on your balance sheet this year, or it may be clear that you need to cap that asset, that surplus, at 0. So yes, we're suggesting to our clients that they receive this report. Just a couple of other points in relation to the income and expenditure. So a question around trip income and whether that's restricted or unrestricted. The accounts direction actually remains silent on it. The only mention of trip income is actually whether you should consider, in certain circumstances, whether this is an agency arrangement rather than the trust. So I&E. Typically, we don't see it as agency, we see it as coming into the books, but we do see a mix of restricted and unrestricted in classification of that. And I guess that is really the question is that primary purpose educational trading and therefore unrestricted, or is it more akin to a donation or a contribution to cover specific expenditure. So there's a little bit of flexibility there. The key is that you're matching the income and the costs within either unrestricted funds or restricted funds. And the very final question was just on the teaching assistant costs. So I mentioned the change this year in that, well, not necessarily a change, it's clarification from the ESFA that teaching assistant salary costs are classified as support staff costs, not teaching staff costs. If in the prior year you had you treated your TA costs as teaching, I would recommend that you do change the comparative as well to ensure that you've got that consistency in reporting. You'll probably just need a sentence somewhere, maybe in the accounting policies or in the expenditure note, to just explain that you've slightly adjusted the comparatives because of that shift. I think it would look too odd if you change that treatment year on year. But you can just change that allocation within the comparatives as well with a footnote to that. So that covered predominantly the questions we have. Any we've not had chance, I've realised we've just run over, so any we've not had chance to respond to, we will come back to you in our circulation of the slides and the recording. The slides and the recording will come out to all attendees this week. We are just doing our final checks on the workbook on the template, but we'll be circulating that over the coming weeks as soon as we can as well. But all remain to say really is many thanks for attending.